Hello, everybody. Welcome. I am so excited to see so many of you very punctual on this bright and sunny lockdown Thursday afternoon in Sydney. Thanks for joining us in your lunch break. For those of you who don't know me, my name is Jess. I'm one of the co-founders and financial advisors here at Fox Hare. I'm really excited for our quarterly economic update. So if you have been with us for a little while, you might know that we've done these before. We're actually going to move these to every quarter because you have told us loud and clear you get so much value from these. So we are very excited to bring them to you. Today, we've got the senior economist back from BetaShares. His name is David Bassanese. Before we get into what he has to say about the world, I want to do a couple of things. First and foremost, I want to acknowledge that today I live and work on Gadigal land, and I'd like to acknowledge elders past, present, and emerging from the Aboriginal community. Of course, welcome any that have joined us online today. Of course, anything that David and I say today is general advice only. We are going to give you the opportunity to use the Q&A function. That is so that you can ask either David or myself questions directly. But of course, we can't answer anything that you have that's really specific to your circumstances. So if you've got any burning questions, go and seek financial advice or reach out to a Fox Hare financial advisor if you already work with one of us. Otherwise, general themes is what we go through today. You are all on listen only, so fear not. We cannot hear you, we cannot see you, except for you, David. We can see you and welcome. So yeah, if you do want to talk to us, that's totally fine. You need to use the Q&A function. So let me tell you a little bit about David and then we will kick off. He is an author of the Australia's Leading Guide to ETFs, or Exchange Traded Funds. He's a senior financial columnist at the AFR, and he's got previous experience with Federal Treasury. And you, David, you've just got a wealth of knowledge in all things navigating through the financial world and markets. You are currently the chief economist at BetaShares Exchange Traded Funds, which is one of Australia's leading providers of ETFs with over $2.7 billion of funds under management. David, thanks for being brave enough to come back and see me.
Good to be with you, Jessica.
Now, last year you told me a really fun fact that you used to own a pub, an Aussie pub in Paris. Am I
right? Look, I was a part owner of the pub. That is true. I helped set it up basically when I was working there as an economist at a place called the OECD. So it was, yeah, good fun for a few years.
You got another fun fact for me?
Look, here's this one. I'm originally from Adelaide, and I'm an AFL fan as a result. So I live in Sydney, but I don't follow the rugby. And I've been to every AFL grand final, bar two, I think in the past 20 years. And they were the 2 years that my wife was pregnant with our children. So I don't know if that's
the right call. I think you did well there. Alrighty. Well, we're really excited to have you back. In the hot seat, if you like. We're going to talk all things markets. So you know me, I can go anywhere. You've got to pull me up if I ask you something that you don't want to chat about. But it's a weird old time at the moment, with most of us living and working from home. From an economist perspective, like, what's going on out there? What's happening in economic markets?
Look, the good news is that we're enjoying a V-shaped global, I say V-shaped global economic recovery, and we were enjoying a V-shaped local economic recovery as well, up until the recent lockdowns in New South Wales, unfortunately. So, yeah. I mean, thinking back a year ago when COVID struck, we were debating, the speed of the recovery. Was it going to be L, U, W? And, it's really been the best case scenario. And ultimately, because the vaccines have rolled out a lot faster than expected, A, they came out quicker than expected, and B, Europe and the US, in the US, I mean, Europe and the US really botched dealing with COVID last year, but they succeeded in rolling out the vaccines very quickly, partly because they botched dealing with COVID. And we've actually had the reverse. We dealt with COVID very well, so the pressure to roll out the vaccines probably wasn't as great. We probably became complacent. So now we're paying for that now. But bigger picture, growth is recovering, and that's why markets have done what they've done. It's because the economies have recovered so well, and there's still a good outlook because I think inflation is still going to stay broadly low, and as the vaccines roll out, economies can shake off COVID eventually, and so fingers crossed. I think the outlook looks as well as one might hope.
Okay, and hey, we've just had reporting season in Australia. Can you tell people a little bit about, what is reporting season and what are you as an economist looking for? And were there any interesting things that came out of reporting season that surprised you?
Yeah, so reporting season is like the report card, that company, like students with their report cards at school. So it's the companies come out and tell their investors, how they've done, what their profits have been, and then they give an outlook in terms of the future. And look, the good news is that, as you would expect with the sort of V-shaped recovery, as I indicated, profits have bounced back in a big way. I think overall corporate profits are up 50%, in the financial year ended June 21. Wow. One of the standouts is that companies, having cut back dividends last year due to COVID, I'm talking the banks in particular, they've been putting back their, rewarding patient investors with big dividend increases, share buybacks. So the banks have been able to pay out more dividends, and resource companies, they've been swimming in cash because of high iron ore prices. They've given a lot of that back to shareholders as well through dividends. So you don't often think of mining companies as big dividend payers, but at the moment they are. So that's been a real standout, the rewards to shareholders. Are cautious out. I mean, companies are always cautious with regard to their outlook. Sure. But that's been, a very good bounce back in earnings, and shareholders being rewarded with dividends and share buybacks as a result.
Yeah, amazing. Good time to be an investor, huh? None of us can go on holidays, so maybe you can help us. Can we look around the world? Can you give us a feel for maybe looking at specific geographies one at a time? We sometimes get caught up in the fact that, the Aussie market is the be all and end all. We're a tiny little drop in the ocean when you look at the global economy. What is happening internationally?
Look, as I said, the global, from an economic point of view, things are doing well. I mean, countries are well advanced in the vaccine rollout. And so let's look at the United States. I mean, more than half the population are fully vaccinated now. They're still dealing with COVID. I mean, funnily enough, I mean, it's not funny, but I mean, COVID cases and deaths, if you like, in the United States and Europe is still high. Or higher than, on a per capita basis, a level that we'd be shocked if it was happening. But relative to what they were experiencing last year, it's a lot better. And so in their sense, they're still opening up their economy, even though, they're still dealing with COVID. And I guess in the case of Europe and the United States now, unfortunately, those that are, going to hospital and dying with COVID are really those that have not vaccinated, for whatever reason. It's now a problem of the unvaccinated rather than the vaccinated, and that's the big difference. And that's the debate we'll have in the next few months about that. But so the US is roaring ahead. Economic growth is very strong. Europe is trying. It's still not as good as the United States. China had a very strong rebound in growth last year. It primed its economy to dig itself out of the COVID problems, which really rewarded our miners and iron ore prices. They've now slowed down a little bit. They've been hit by another wave of COVID, but they've also just, tightened their reins a little bit after having stimulated their economy so much last year. But overall, countries are shaking off COVID slowly but surely. Their economies are rebounding, and they're sort of travel is happening even in some of those countries. So we look enviously. What's that exactly? So so that's the state of the world. I mean, in a general sense.
Okay, so I'm hearing that America is sort of roaring ahead. Europe's sort of following, but certainly not as fast, and China's doing some good stuff on the recovery front. What about places like, India and Brazil and some of those emerging markets that are still, I think, grappling quite significantly with COVID. How are markets faring over there?
Look, it's been mixed, fair to say. I mean, all markets have benefited from the global recovery. So the US market is, at record highs. It's testing record highs, as has our market. So that's helped pull up a lot of markets around the world.
Yeah.
And so India's market is doing okay. Brazil doing okay, not as good. I mean, the Chinese market has been one that has pulled back since around February. And emerging markets generally haven't done as well in the last few months. Because I said China's economy has slowed down a little bit, which has got people worried. China's done a few things on the regulatory front. Some of their big tech companies, there's been some rule changes which have unsettled investors. So that's helped not helped their market. But broadly speaking, the challenge in emerging markets is, as you point out, they're still not over COVID. They're still dealing with COVID. The vaccine rollout is not as fast as it has been in the developed markets. So they're going to be the last parts of the world really to be able to get over COVID. So they're sort of dragging, lagging, I should say, in terms of that recovery.
Yeah, okay. And it is interesting to see, looking at the Aussie market, even in this new sort of, I don't know what version of COVID lockdown you're up to, depending on where you're located, but there was some fear, particularly from some of my members that I was talking to a couple of weeks ago, that they thought in the coming weeks or months there would be some sort of significant domestic dip. We haven't seen it.
In terms of economic growth or the market?
Yeah. The markets, yeah.
Yeah, well, the market's been, our market's been pretty surprising. Well, surprising. I mean, in terms of the growth, we're clearly going to have a dip because, New South Wales is 25% of the economy, and that's, gone into lockdown for a couple of months now. And, Victoria on and off again is back into lockdown, and so is Queensland. So what we do know is that GDP, national economic output, is going to be negative in Q3. We're going to have a big drop in economic output in Q3. And, we should get a bounce back in Q4. But we've taken a big hit with growth.
Yeah.
But the markets have just moved up higher. And again, what's helped is that the US economy is moving higher. The rest of the world is dealing with it. And investors are looking through the downturn. They know growth is going to be weak in Q3, but there's a very good likelihood with the vaccine rollout that growth can bounce back pretty quickly in Q4. So in markets being forward-looking, they're looking across the chasm, if you like, the gap.
Yeah.
For better times ahead.
I can see the other side. It's not too far away. Okay. Don't forget, if you're online, that you can use the Q&A function to ask David or I any questions that you have. I think we need to talk about the property market in Australia. David, what is going on with property in Australia right now?
Yeah, it's only been 10 minutes, so it's time to talk about property.
I waited 10 minutes. I waited 10 minutes, David.
No. Look, property is, again, I wrote a blog a few months ago saying that I thought property was going to, take off this year. Or certainly it's bottomed and was going to take off. And more, I guess economists are sort of saying that and recognizing that the bounce and we've had, and it all comes down to affordability. I mean, the quick story with housing here is that we did have a housing downturn prior to COVID. Like Sydney market was pulling back for a number of years on the back of a quantitative, credit tightening. Then COVID struck. So that led to a lot of uncertainty and an increase in unemployment temporarily. Then the RBA slashed interest rates. And so affordability, the combination of house prices having gone sideways to down for a number of years, plus the RBA cutting rates, affordability suddenly looked quite good if you could have a mortgage. Now, if you're a young person without a deposit, that's a challenge. But if you could get a deposit or you wanted to trade up, mortgage affordability was pretty good. So that plus the V-shaped recovery, all the conditions are in place for a remarkable rebound in house prices, which is what we've been getting. And I think that that's been disrupted in the short run by the lockdowns. But at the moment, the RBA is promising not to raise rates for a couple more years. And they're actually targeting getting the unemployment rate down to the low 4s. So they're really happy to see the economy run strongly if it can for the next few years. So that's a good backdrop for house prices to continue on, depending on where you are in the market, to continue moving higher. Because on my measures of affordability, we're not at the peak levels of unaffordability, if you like, that we have been in past cycles. So that means the market I see the market can keep going higher until you reach a point where the average household can't afford to pay any more at an auction. And there's certain levels historically where that's kicked in, but we're not there yet.
It's interesting, because for a lot of younger people, as you very rightly point out, it's a market that continues to race ahead, and you're trying really hard to squirrel away all of the pennies that you've got, and you're consistently getting outstripped. And what many people are now thinking about is, well, that watermark of X percentage that I needed in savings before I would tip my toe into the market, maybe that needs to come down if it's an ever increasing market. What do you say to people that are trying really hard to get on the property ladder for the very first time and watching the market race ahead?
Look, it's a very, very tough situation. I mean, the market, a lot of the property, again, I don't see a property price crash coming. So those that over the years have been waiting for a 20% correction in the market to get in have been always bitterly disappointed. And I don't think you can count on a big correction in the market ever. You can count on a period where prices go sideways to maybe down 5%, possibly 10% in a serious downturn. But, there's no easy answer. Just the nature of our market is that interest rates are low. They're going to stay low, which has pushed up asset prices. The big driver of house prices in Australia also is we tend to be very urbanised. And this doesn't get a lot of coverage generally, but the RBA done some work on this, and that a lot of us live close to the cities. And we have a situation where density in our cities isn't very high, and we don't have good transport links to have people living outside of the cities and then commuting in. So, the land is of a premium, and that's why house prices compared to income in Australia, say, compared to other countries like the United States even, are very high because of that proximity premium, if you like. We need to live close to the handful of major cities we have. Now, one solution is that if you can live in a regional area to get a foothold and work from home, or have more flexible working arrangements, that's an option. Because obviously properties are more affordable outside of the major cities. But other than that, at the moment, all I can say in terms of the outlook, I think for the next year or so, prices are going to continue to probably grind higher and then plateau. Now, there will come a point when the RBA does start to raise interest rates again, renormalise them, if you like, but they won't go very high. I think if the RBA raises rates 1%, possibly 2%, there'll be a big impact on slowing the economy, and they won't need to do much more. So the days of a lot higher interest rates are well and truly past, I think. So there may be an opportunity to maybe get better prices in a few years' time, but that's only after prices have gone up while you're waiting for that. So
I was thinking a couple of weeks ago about this person that I met, I'm going to say 5 years ago, was convinced that there was going to be this huge crash in the Sydney market, like looming, all in cash. And I think about him and think, oh dear, he probably could have bought something for probably half the price that it would be worth today. I hope he's happy with his choice. And that comes back. There's
a lot of global hedge funds, it's not just the average investor. A lot of very sophisticated investors around the world have been betting on a housing crash in Australia and a banking problem as well. And myself, many have sort of said, it's unlikely, again, because of the nature of our market, it's a supply constrained market. House prices are high for a reason, and it's largely because of the way our cities are constructed. It's not that they're just a bubble. It's unfortunately poor urban development policy. Actually, if you want to blame anything, and as a result, they're going to stay relatively high. So international investors that look at our market say, oh my God, house prices are so high, that's got to be a bubble, they've got to crash. And what they sometimes don't understand, it's the nature of our market, the very concentrated nature of our cities that explains that.
Very interesting, very, very interesting. And we know that the Bank of Mum and Dad is propping up a whole heap of people who are entering the market as well. And frankly, over the next sort of 10 years or so, there's going to be a massive transfer of wealth. And that's going to be interesting to see how that plays out in the Aussie market, both in property and shares too. All right. My favorite time. Did you bring your crystal ball?
It's right here. It's looking a little, I'll just dust it off. I'll just
give it a good shake, get it ready. You've sort of given us, I mean, last time when we spoke, I was thinking about this morning, I reckon it must have been March or April last year that we spoke. Like we were right in the thick of this uncertainty and craziness. And
yes.
And you know, what you're saying is that broadly, things are okay. Things aren't terrible. You don't see any sort of particularly huge looming issues, but you know, for investors, what are the things that you think they need to know if they either are existing investors in well, they are all are going to be, because they've either got their money in super or money in super plus in personal investments, but what do you need to know if you're already invested, and what should you consider if you are just about to start investing?
In terms of the market, what they should know now. Look, I think, again, it's a world where, as we've just discussed with property prices, I mean, I think at the moment there's some debates going on about whether or not the very sharp rebound in economic growth globally is going to lead to an inflation breakout. We've seen some inflation numbers in the US that have been higher than expected. My sense is that that's still going to be, I don't anticipate an inflation breakout. I think what we're seeing in the US is really a short run disruption story. I won't go into the details, but basically, I think be fairly comfortable with the idea inflation and interest rates are going to stay pretty subdued over the next few years.
Yeah.
And as a result, that's going to keep asset and equity prices well supported. Now, there's going to be, you know, there's going to be bumps along the way. I mean, one thing is that central banks will eventually look to increase interest rates. You know, RBA's rate is at 0.1%. The Federal Reserve in the United States is, again, close to zero as well. And the next few years is going to become a move where they raise rates. And that may well be where you get a correction in the markets, maybe 5 to 10% pullback in the markets. But, you know, as is with markets, they never go up in a straight line. At the moment, they look like they're going up in a straight line, but, you know, you can get wobbles along the way. And that's probably one risk factor, you know, down the track. But again, these are things that, you know, markets get through. The biggest risk for markets in terms of a big bear market, you know, more than 20% decline, 50% decline, you usually need a US recession. And that is not looking very likely for the next few years, you know, until they get back to a full employment situation. There's still a lot of, you know, spare capacity. There's a good runway for growth, if you like, in terms of the US economy, but before we need to worry about a recession. So I think that outlook is still looking pretty good. And, you know, we're talking about the TINA trade. I don't know, your followers are familiar with the TINA trade. There is no alternative to equities in this very low interest rate environment. So that's tending to what will support people, you know, staying in the equity market. The other thing, just quickly, is that, again, emphasize, you know, Australia is, as we've said earlier, you know, what a small part, you know, not super small part, but it's a medium-sized country by global standards, but as a share of the global share market, you know, it's 2% or something like that. So there's 98% of opportunity outside Australia. And there are some great growth thematics going on in the tech area, in the environmental area, and you know, definitely look for opportunities, not just in Australia, but around the world for investment opportunities.
I think that is very, very smart. And you guys have some pretty cool ETFs that fit those thematics as well. We are big fans of what you do.
Try very hard to offer those.
Yeah, and hey, some of yours are like winning awards and they're accredited, and yeah, you guys are doing great stuff over there. All right, I don't have any Q&A for you. I think this has been really interesting. It's nice. I went to a Global Economist Forum earlier this year, and if I can quote them, they said the outlook is good. That was sort of the general theme. I think you're continuing that. I think the outlook is pretty good, notwithstanding the fact that we all are probably sick of our loved ones being in such close proximity. And yes, we do know that that New South Wales in particular has taken a pretty big bashing over the last couple of months, and that's definitely got to play out. But as you very rightly say, investors aren't as spooked as they were this time last year, or just earlier last year. They can see the other side, and they know that once vaccination rates go up, there is another side, and we will hopefully return to life as normal as we can. Okay, we have one Q&A. Hold on. Don't forget to use it because you've got access to David. Thank you for the updates, David. Great. You mentioned New South Wales contributing a major GSP in Australia. What proportion across the other states? What is the proportion across the other states, and has this changed much due to COVID? I think they're talking about GDP.
Look, it hasn't changed that much. I mean, sometimes the state share of national output can vary a little over time, depending on what are the major drivers of the economy. So when we have a mining boom, you know, the WA, Queensland share tends to go up a bit.
Yep.
And when we don't, it goes down. And when we have a property boom or a tourism boom, areas like New South Wales do well. But so the shares don't vary that much. But so Australia, you know, off the top of my New South Wales, I know is around about 25%. Victoria's around about 20-ish%, and then you know the other ones are 10 to 15% in areas like WA and Queensland are the next largest states. So it doesn't vary that much. And at the moment, you know, there was a period where WA was a big share during the last great mining boom, but that's come back down in more recent years.
Okay, so no huge changes to those sort of weightings because of COVID.
No, and again, like last year we all kind of had lockdowns around the same time. At the moment, you know, New South Wales is doing it a bit tougher than say Queensland and Perth or WA. So you look at a very marginal level that our share of national output will go down.
Yeah.
But thereafter will bounce back again. So
amazing. All right. Well, that's the only question that we had. Oh, hang on. I feel like now we're getting another one. If you've got any more, chuck them in ASAP so that I can sort of read them as we're going. So from your point of view, with the property market in Sydney set to continue to rise over the coming years and increased mortgages that will be needed, do you feel there will be a point where it is not a smart investment decision to purchase a home to live in? It would be more efficient to continue to rent and use funds to grow wealth via other methods. This is a general advice only style question, David, just so you know.
Yeah. Look, with that caveat, look, there has been some, given the very low level, given the very low level of interest rates, I mean, some analysis does suggest that now is actually, not a bad time to buy, assuming you can get a place that's affordable. So the rent versus buy equation has gone a bit toward the buying camp at the moment.
You mean buy to live in? You mean be an owner-occupier? Or just buy?
To buy versus renting, to buy versus renting.
Okay.
And I've seen some reports saying, compared to rental. Now that may all adjust. So it really depends on typically it's been more expensive to buy than rent, and because you're paying that extra mortgage because you're getting the capital gains of owning the property. So in a all else constant, it should be more expensive to buy a property to live in than to rent a property, if not something going wrong. But I think at the moment, because of the very low level, and as I said, going back to affordability, there may be cases where you can buy an apartment, say maybe not in Sydney, but maybe in areas like South Australia or whatever, with the various grants that have been available, actually buying as stacks up versus renting. Now that's not the case everywhere, so it's really hard to generalize, to be honest. I mean, as I said, the thing about property in Australia also, there's no there's no such thing as an Australian property market. They're also different, and they, valuations in Adelaide. I come from Adelaide, is not that bad from a Sydney point of view. So it's and even from an Adelaide point of view. But Sydney is especially unaffordable, expensive because of the concentration that we have here as a major city.
And as we talked,
yes, it's a very hard question to answer without knowing the specifics. But I think this is an environment where there's some possibility that it does add up to actually buy, But so do the sums because of those very low level of rates.
And as you talked about before, it might be that you can service the loan, but can you get in? It's the getting in that's the major
exactly.
hurdle.
You need that deposit requirement.
Yeah, or you get a guarantor, or you get lender's mortgage insurance, or whatever. We've heard of people joining forces with their siblings or besties or whatever. People are getting a bit creative in these markets where there's such a high sort of barrier to entry. Hi, I've got a random one for you that's come through. You ready?
Good.
Outlook for gold?
I'm tending not to be bullish on gold at the moment. Gold does well in a high inflation environment or in a weak US dollar type environment or risk-off environment. Basically, I think we're in a world where growth is recovering, inflation is going to stay low. The US dollar probably is going to start to strengthen, which is another story. But that's on the back of the US economy doing so well, and their central bank starting to reduce their quantitative or their bond buying. They've been buying a lot of bonds.
Yeah.
As they scale that back, that's going to maybe strengthen the US dollar. So the combination of all those things suggests to me gold's not going to shoot the lights out. And I know some people do like gold. I mean, gold is a good diversifying asset, because if things do go pear-shaped, gold can do well in that environment.
Yeah,
or if you believe inflation is going to break out globally, then gold is a good investment. But if you don't believe those things, as I tend not to, then don't have a bullish outlook.
Interesting. Hey, we've warmed people up, so we've got some more. Is that okay?
Sure.
Anonymous attendee would like to know, what would you say about investing in property outside of the city one lives in? For example, purchasing in Adelaide or Perth. Can I add to that? What I'm seeing a lot of people now start to think about is actually considering regional areas as well, for the very reasons that you were talking about before. More and more people can start to live pretty normal lives working in what was maybe considered a city job from the luxury of a regional area. What do you think about places like, regional centres across Australia and places like Perth and Adelaide?
So I mean, in terms of housing affordability, the measures are pretty good in areas like Perth. I mean, Perth did get cheap briefly for a while. It's starting to rebound at the moment, but Perth, Adelaide, Brisbane, they do look more affordable than Sydney at the moment. So there used to be a thing in the tax code where if you bought an investment property interstate, you could go and visit it a couple of times. You could write off tax going on a holiday, but you can't do that anymore. Apparently. I'm not an expert on that, but so that sort of made so it is harder to have an investment property in another state, right? Because you do rely on others to sort of help look after it. I mean, it does make sense in that sense. It's probably a more affordable option, but it's obviously a trickier thing to do. But regional area, I mean, again, if you can, depending on the flexibility of your employer, and I think going forward, I mean, I would like to see, more public policy efforts and corporate efforts at having people work in regional towns, repopulate regional towns, reinvigorate them, and have more people working from home and telecommuting and those sort of things. And definitely a lot more affordable out there.
That's why I'm so enthusiastic about it, because people come to us and they're young and they're ambitious, and David, they want everything. They want a home, they want to send their kids to a really good school, and then they want to, of course, retire early with a rather large passive income. It's bloody hard to do that if you've got a $2 million mortgage in a capital city and If you can move a couple of hours north, south, or west or east, if you're on the I don't think anyone's joining us from WA, but if you are, oh yes you are. Hi Gemma. Gemma's here from WA. You know, the barrier to entry or the cost of property just is so life-changing, because you can actually achieve, you can probably achieve some of those goals that were a wish in many instances, and B, you can probably get them a lot sooner.
And just a quick, again, I'm not a property expert, so take this with a massive grain of salt, but I mean, one area of the market which hasn't rebounded as much as standalone homes at the moment has been the inner city apartments.
Yeah.
You know, because of initially overbuilding, but obviously we've lost a lot of demand, you know, the international student demand and whatnot. So there's an area that's maybe lagging the recovery.
Yeah.
And for, you know, and I actually, again, along with regional, again, I lived in Paris many years ago, as you know, with the bar, and Paris there's some cities in Europe where you can live in a city and have a great lifestyle, you know, and in Australia, we tend to not live in our inner cities. And that's another area where and I know there are moves in Sydney to try to make the city more livable, but that's another option, you know, inner city apartments, right downtown in the CBD, are, you know, potentially relatively more affordable and can give you a good lifestyle as well. And if you don't need the quarter-acre block in the backyard, and just another option.
No, I think that's very true. Everyone's got an opinion on politics in Australia at the moment. It's quite an interesting world. We're not gonna get your take on politics, but we do want to know. There's an election looming, probably early next year, I think. What do you reckon that's going to do to markets?
I don't see, usually elections don't have a big market impact as a rule. I mean, and particularly now, without getting into politics so much, but I mean, the Labor Party as we all know, they went in with a lot of, you know, major policies like changes to capital gains tax, negative gearing, franking credits, all these things. They were big targets. And it scared a lot of people off, and I think they're going to go into the next election, you know, as a small target. But we did see a market impact last time around because, you know, there was a fear that, you know, Labor would get in, and if they did these things, that wouldn't be good for the market and for the property market. So that was one specific example where, you know, elections can have a market impact. But I think at the moment, I don't see a lot of major policy changes from either party, you know, going into the election that could be overly market sensitive. So I think it's going. What we do know, typically in the weeks leading up to an election campaign, you tend to get a period of retail sales softness. So spending does tend to soften a little bit, but again, that's just, you know, I wouldn't get too worried about that. That's something that just tends to happen as part of the election cycle. But at the moment, my reading is I don't see a lot of major policy differences, you know, ultimately between the parties. So I don't see that, you know, upsetting markets too much.
Interesting. Hey, we're not allowed to give product advice, but someone has asked, and you may not know this off the top of your head, and it's okay if you don't. Do you know some of the best performing BetaShares ETFs?
Look, I can say that you know, on and off, I mean, funnily enough, our best performing funds tend to be the geared funds. I mean, as you would expect, right? So when the market rebounds, you know, we have a couple of funds that give you like geared exposure to the US market and the Australian market. So just from that gearing, you know, when the market rebounds, they perform the best. Of course, when the markets don't perform as well, they perform the worst. So it's you know, it's horses for courses in that sense. But you know, for some people, they're good, you know, long-term growth ways to invest in the market or to sort of bet on short-run movements of the market. But more generally, you know, again, the technology, global technology, the NASDAQ, for example, has been doing very, very well. That's the US index that tracks, you know, the big tech companies like Google, Amazon, and Facebook. That's just been, you know, on a tear really since COVID. And it was doing very well in the years prior to COVID. Basically, technology globally has been outperforming almost everything in the years leading up to COVID. And then when COVID came along, it actually did even better because it became this defensive part of the market. Then it had a bit of a underperformance. Let's say we sort of went sideways for a while things that got absolutely smashed by COVID, things like energy and financial companies, they rebounded. But now I think technology is coming back to the fore. So things like the NASDAQ, global tech, cybersecurity, robotics, we've got a number of different growth tech thematics, which are all tending to do pretty well. One that's not doing well at the moment, I did mention, is the Asia technology area, because the emerging markets generally have pulled back. So they've gone against the tide in the last few months. But to me, that's opening up some long-term value opportunities in that market.
Yeah, okay. Hey, we've got a couple of other questions, which I reckon we can sort of merge. You and I like talking about this. Thoughts on ethical investing and long-term trends. So we know that BetaShares have got a couple of different ethical funds, and you've recently launched your diversified ethical funds, which is really exciting. What do you say to people who aren't investing ethically because they think they've got to give up performance?
You'd be surprised that, as we say, you can profit from your principles. I mean, the nature of ethical and environmental, but the focus on ethical investing, typically you take out things like gambling, alcohol, tobacco, but also fossil fuels for good, some people's versions of ethical may differ, but in terms of our ethical funds, we have a very wide set of screens that take out all of those things. And we also have something that requires companies to be leading in terms of having a low carbon footprint within their industry. Now, the nature of those screens over the last few years has meant that you've typically taken out energy companies, which have been challenged by weakness of oil prices and the shift toward renewable energy. And you've screened in tech companies, A, because they don't engage in a lot of controversial activities, and B, they have a low carbon footprint. So funnily enough, those screens have led to pretty good outperformance over the last few years. And going forward, I mean, I think, as we've said earlier, I mean, I think increasingly, ethical ESG type considerations are becoming more and more important for investors. And companies that are switched on and meet screens in that way, it's actually a good signal that these are well-run, forward-looking companies. And so as a byproduct, they tend to deliver pretty good performance. So it's almost a new economy, old economies type, way of thinking about things as well.
Yeah, totally. And as you just very rightly pointed out, your global fund, tech, healthcare, lots in the US market, it has done phenomenally well over the last little period.
Yeah, over the last few years, and through COVID as well. So as I said, it screens out a lot of the energy companies that have been struggling, screens out banks that are lending to fossil fuel producers, and screens in a lot of the tech health companies, the really dynamic companies.
Yeah, and I guess the second part, which was another question, was, if you're a first-time investor, are you investing just in the Aussie market? Are you investing in the global market? I would say to you, why not use some of these new products like what you've got, which are now these diversified ETFs, which you've got an exposure to not just one or the other. You don't have to trade them off anymore. But what are your thoughts?
Yeah, look, it's a very convenient way of getting diversified exposure to both, Australian and global equities and bond and fixed income bonds. So the beauty of these funds now is they can be diversified exposure for a certain risk profile. So if you don't want 100% equities, you want some bonds to sort of dampen the volatility of your returns, protect you from some equity pullbacks, you can get something with a bit more bonds. So we have a number of funds that have a different risk profile, but wrapped up in them are exposures to both Australian and global ethical companies, or ones that meet these screens, and also bonds. And so again, this is another area, green bonds, for example. So these are bonds that are issued by companies that are then used for green developments, renewable energy, these sort of things. But also all the bond issuers in that bond fund need to meet the ESG screens as well. So it's like an ethical bond type exposure. So we have a separate fund for that, but we also have, as you mentioned, the diversified funds that wrap all that up into the one fund.
Yeah. And I guess it's about going back to basics as an investor and thinking through, what are you investing for? How much money do you need? What does that mean from a budget perspective? When do you need it by? That helps you work out how much risk you're willing to take. And again, not trying to time the market like we were talking about before, that regular dollar cost averaging strategy, which has been proven to be a very, very wise thing to do over the long term. I mean, you can get really excited and really into it, but I think it's about making sure that you're actually stepping back and thinking through, well, strategically, what am I doing that for? And that should help you lead the way in terms of making those informed choices about exactly where to invest in and how regularly as well.
No, for sure. It's a very, very straightforward approach in terms of using those funds. And as you said, if you can set up a dollar cost averaging type process as well, you can, you're basically buying more when the markets are down and buying not as much when the markets are up. It's actually not a bad strategy over time.
Amazing. Hey, David, you've given up your lunch to be with us today. So I want to say a massive thanks on behalf of everyone that's joined us, but also from the Fox Hare team. We love working with you. We love that you are always so keen to come and chat to our members and have, Q&A. Some people aren't keen for Q&A from members direct, but you guys are. So I just wanted to say a huge thank you for being part of our chat today. And hey, stay safe and sane.
You too.
Thank you.
Bye for now.
Bye. Well, guys, we hope that today you learned a little bit more about, David's take on the world, both here and at large. It sounds like we shouldn't be too panicked by what's going on, notwithstanding the fact that for most of us, we've got a little bit more of lockdown left. As I said up front, we're going to make these quarterly. We've heard you. We know you love these. So stay tuned on the socials to hear when our next economic session is coming. If you know someone that didn't get to be with us today, but you think that they're wanting to know what David had to say, fear not. We are going to do a wrap-up newsletter in the coming week or so. And so feel free to pass it on to anyone that you think will find that helpful. Hope you have a wonderful Thursday. Thanks again for joining us, and we hope to see you soon. Bye.